From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It's Friday, November 11th, 2022, Veterans Day, a Veterans Day edition of the Macrocast. I'm Tony Fratto with Penta Group. John Fagan, Brendan Walsh are our co-hosts of this Macrocast for all these years and partners with Markets Policy Partners. And guys, but first, I do want to recognize it is Veterans Day, and all of the men who've worn the uniform in defense of the country and its national interests. Just so much respect and honor out to them. John, I think you were saying you're in Boston for a former track coach up there who's being recognized today.
Yeah, it really is a special event. We made the trip up, and it's to honor my English teacher and track coach from Reading Memorial High School, Hal Croft. Hal was a Silver Star winner as a Marine in Vietnam through some of the most difficult engagements there, and it shows just the kind of character that that it takes to be in the military and to persevere in these very challenging situations. And he really brought that to the classroom. He brought it to the track. We were astoundingly, he's in the Track Hall of Fame. We were 10 years undefeated in spring track. 20 years undefeated in spring track and 10 years undefeated in winter track in dual meets when I was a senior. Talk about a little bit of pressure. You don't want to let your coach down under those circumstances. A truly special individual and someone who's passed on so much to so many. So we're really thrilled to be up here in Reading, Massachusetts, my old hometown, to honor Hal Croft and other men and women in uniform,
including your father, who was the valedictorian of his class at West Point.
West Point, yeah, he was. He was. It was class of '62. So just enormous respect for the men and women in uniform and who answer the call to serve.
Absolutely. So, out this weekend, find a veteran, thank them what they've done for each of us and for the country. It's an eventful week, guys, and an eventful week for Macrocast. My final Macrocast, which is kind of amazing. Maybe we'll talk a little bit about it at the end. But my final Macrocast was some big moves in the market. But what dominated the week early was the midterm elections, which people have been looking to for most of the year, pointing to this elections for what it's going to mean especially for the Biden administration and for politics going forward. We saw the returns coming in. They're actually still coming in some races, and not everything is completely decided. I think we all can all feel pretty confident that the House is probably going to be Republican. I think it's probably the outcome. It would likely be only by a handful of seats, but a Republican caucus that is not settled on what they think about leadership and how to govern going forward and how to run the House. So a pretty unsettled situation in the House, even if Republicans do manage to get that whatever it ends up being, a 5 or 6 vote majority. The Senate is completely undecided and could easily go in either direction. I think 97 seats are decided, 3 are still hanging out there. 2 will come to conclusion with, some counts and recounts, Nevada and Arizona, over the next maybe hours, if not the next day or 2. Georgia is headed to a runoff, regardless of who ends up with, more votes when they've all been counted, unless somehow Senator Warnock ends up with 50% plus 1, but that doesn't look likely right now, given the number of votes out. So looking for a runoff, and so we won't know once again. Likely, we won't know once again until December who controls the Senate. But razor-thin margins in both states. The expectations, especially in the final weeks of the race, were that the Senate was probably going to be a toss-up, maybe leaning Republican, but the House was gone, and you're going to have massive, Republican flips. People predicting things like, anything from a net 20 to net 40 pickup for Republicans, a red wave. There was lots of talk about red wave. There was no wave at all. Not at all. Yeah. The
2 big things I saw from this was, one, polls in modern day are completely worthless. They don't capture at all what the popular sentiment is. And that the media, what the popular narrative on the media isn't necessarily what is worrying people. Inflation was the big narrative. Turns out that, maybe reproductive rights were a bigger issue than that people realized.
Yeah, one of the other takeaways, obviously, is that this was a very positive outcome for DeSantis. His star on the rise, comfortable win in Florida. In terms
of the country going forward, that's probably the biggest narrative. You even saw, Rupert Murdoch turn on Trump, and you had DeSantis, with an overwhelming victory in Florida.
Yeah. Do you think, Tony, that this is really something that is the media making too much of this sort of swing in the polls of power in the Republican Party from Trump to DeSantis? Do you think that there's a course correction that goes back to Trump? Or
I think one thing we know is that wishing things to happen isn't the same as things actually happening. And I think there's a lot of wishing right now. That said, it was a really good day for DeSantis, and not just that it was a blowout win in Florida, but that a large number of Trump-backed candidates failed, and there is a lot of discontent out there right now. And I still own a home in Pennsylvania and have lots of relationships there. Pennsylvania Republicans are very upset, and I've heard the same in other states where there was a feeling that these were layups for Republicans in this year.
Pennsylvania people are the most parochial human beings I've ever met. If you're from Pittsburgh, you love Pittsburgh. If you're in Philly, you love Philly. And the Republicans chose to run a rich doctor from New Jersey. You could have been
not just
anybody else, and he would have won.
Yeah, right, absolutely. Like, he lives in New Jersey. He actually, he still owns, still has a Turkish passport, and not not welcoming and in the state, and but an imperfect candidate on the Democratic side too. So if you had, I don't think there's any question, and whether we think there's a question or not, I can tell you everybody I talk to in Pennsylvania says Dave McCormick wins that seat by 5%.
I think you're right. Yeah.
It's not close, and I think that's probably true. So a lot of fumbles. Questions to your question, John, is like, what does this mean in terms of, is it a change, and what happens with the presidential race go forward? I think let's see what happens. We're not going to have more primaries for a while, so we don't know if the Trump, strength on primaries is going to be a thing anymore. I think the only primaries that he has on his mind are his own, and he won't be paying attention to others. So we're not going to get that kind of signaling on things. But I would say I think DeSantis is in a pretty strong place. He's coming out of this week in a pretty strong place, and I know a lot of Republicans feel that way. That he's acceptable to take the handoff from Trump.
And now for financial markets, what does this mean for the debt ceiling? The Republicans have a very small majority in the House, and I suppose it doesn't really necessarily matter whether it's the Democrats or the Republicans with a small majority in the Senate.
Well, but except that the Republicans are going to be, if it means raising the debt ceiling when Republicans have control of the House, I think it's a potential for disaster, because it's not a question of whether they who supplies the votes. Like, they'll supply the votes, but they're only going to try to extract pain, right? That Democrats are going to have to.
What's in that bill to get the vote?
So the question is, do they find a way to raise the debt ceiling in a lame duck session? Which
Bernie Sanders brought that up a couple of weeks ago, saying we should do that.
Yeah, I think it would be wise. And as we look, whatever happens, we're going to have divided government. I think that's pretty certain for the next 2 years, and a narrow window for doing things. But there are issues out there that are going to be harder. More funding for Ukraine as that effort continues, and keeping support for Ukraine. There aren't big legislative proposals. I mean, if you ask anybody, what was an issue that people were running on? No one was running on issues on new proposals and ideas. They were running on, anger, right? Anger over the Supreme Court decision, anger over inflation, as you mentioned earlier, anger over the direction of the economy. These aren't the kinds of things that say, well, and then so here's my legislative proposal to go fix those things. So we didn't see, big healthcare legislation or tax policy or the kinds of things that you see people running on generally And so it's a strange primary that way. I think what we're looking at is, what Biden administration has right now is its, regulators in place, and now that they're through the midterms, I think they probably feel they could be as aggressive as they want to be. And, people like Gary Gensler at SEC and Lena Khan at FTC, antitrust folks over at DOJ, all the regulators, I think, are going to be pretty active, and especially with knowing that there's a ticking clock of the potential of them, losing their authority in 2 years. I think we're going to see a lot of activity from the regulators.
I think that's the biggest takeaway and most important, especially for financial markets, and especially with Gary Gensler at the SEC.
Yeah, there's also the Republicans and Democrats are pretty well united on the U.S.-China issues. And those are significant. Clearly, there's an incremental push to tighten up. We saw the move on semiconductors. And, there's a lot of trepidation about China's response to that might be. And, we don't know if we've seen the fullest extent of their response yet. They certainly have other levers to pull. So that could be a feature of the next 2 years of the Biden administration.
We saw White House announce that President Xi and President Biden will be meeting. So that should be seen as a welcome step. Another thing we saw just, I think, overnight, and, maybe it's time to switch to macro a little bit, but two of the big macro stories from this week. One is the blockbuster CPI print that came in cooler than.
That's what Democrats should have been running on, is the Inflation Reduction Act.
I don't have advice for them on what they should have done. It's hard, yeah. But they did okay. I mean, closing the chapter on the midterms, they did much better than expected. But the CPI print and to me, the sort of twin stories. Well, I mean, the CPI print is by far the biggest story. Second is it looks like maybe loosening of COVID restrictions in China that's having some impact as well. But can we talk about CPI? I mean, this was soothing is the word I used.
I mean, because the Fed made the CPI it basically was the data point that decided whether they're going to over tighten or under tighten. The markets were coiled to spring one way or the other. But when you look at the underlying details of this report, I think it's, knock on wood, somewhat clear that we've seen peak inflation. And in fact, if you take out the housing component, the shelter, and you also took out energy, we actually saw deflation. The CPI was negative on a month-to-month basis.
And you would take those out, especially housing, because there's such a lag, right?
Right. So we do have real-time data, both from, a number of apartments.com and Zillow and things like that show both rent and house prices peaked, 2 to 3 months ago and are coming off hard. They follow they lead the CPI component by about 6 months. So we're getting into the point where we're actually going to start seeing the month-to-month shelter component start to be actually reduced, and maybe down the road could actually be close to zero or negative. So the Fed has to be aware of that, and more importantly, the disperse components that in the last two reports were high, those moderated. So you can see both. In the goods sector, we actually have deflation. So used car prices are coming down, airline fares are coming down, and even a lot of food items are coming down. And then most importantly, where the Fed was very worried was that service inflation was accelerating. And while we are seeing some higher wage gains at the low end, especially in restaurants, it's not following through into the broader service sector. We're seeing a moderation in those price gains. And even, which is a very leading indicator, China's PPI, producer price index, so that the things that we build that then seep into the cost of goods, it was deeply negative in October.
Interesting. Yeah, one of the questions I have for you guys is, how much do we see sort of false flags with CPI? Or does it tend to trend?
It tends to trend, especially the housing component, because the housing component is actually a 6 months average. So it's very difficult for it to massively bounce up and down from one month to another. So the previous 3 months, we saw, kind of the peak, and now it's going to come off. But also in terms, I mean, small components can have, up and down from month to month. But the broader trend of CPI tends to be, less volatile.
The other thing that was reassuring about the number was that this is finally, from the investor mindset, this number makes sense. You've been seeing commodity prices. You've been seeing all these indicators coming down. Yeah. When you saw those upside surprises in the previous months, that awful question that investors hate to have to ask themselves, what am I missing? What am I missing here? And that was a very scary question. The Fed made it even scarier by really having the blinders on and taking, the global financial markets really to the brink with their breakneck tightening. But this narrative here is potentially a nice little oasis for us, where you get inflation topping out and rolling over, coming dutifully down, progressively over the next few months in line with expectations. There's obviously slowing going on in the U.S. economy, but it's not, the housing market may have fallen off the table already and maybe still in free fall. But most of the rest of the economy is softening, but not collapsing. You still have
and actually where we're seeing the layoffs is in the sectors that were so much money flew into them, like the tech sector, that things got in kind of bubble territory. So now you're seeing layoffs in those, but you're not seeing layoffs, kind of in the nuts and bolts parts of our economy, which is a good sign that we actually could, as long as the Fed doesn't over tighten, actually have a soft landing, because the fourth quarter GDP is actually is tracking around 3 to 4%. So we're well beyond being in negative growth.
Yeah, and earnings season, which we're on the tail end of, really wasn't apocalyptic. We got some very high profile misfires by the big tech companies, right?
Yep.
But that really doesn't show that much about the bedrock of the economy. And
well, what it kind of showed was the transition out of COVID. We're not staying inside and watching TV all day anymore. We're going out, because Disney earnings were actually very indicative of it. The stock went down because their streaming service underperformed, but right. their amusement parks and cruises actually outperformed.
Yeah, and so this is, we've been sort of waiting and hoping for this back half of the year relief as inflation tops out and the Fed downshifts its tightening cycle. They're not finished with the tightening cycle, but just downshifts, right. And that's how investors begin to see the,
And that was our take following that was our take following the Fed meeting, that take the bird in the hand. The Fed wrote in the statement that they see a reason to slow the pace of tightening. Then Powell got on the TV and saw that the market was up and tried to talk it down, saying, in the future, we're going to raise way higher than you guys think. What we've seen since the CPI print is basically every Fed president and governor is on board with slowing the pace of tightening, because they see what they've done is probably enough. And now the market is pricing them in to not get above 5% on the final Fed funds, and actually is pricing in possibilities of cuts in the second half of 2023.
And just to finish the thought on the Fed, for the longer range outlook that we have, that pricing in of rate cuts at the end of or toward the back half of next year is where we think there's a potential real disconnect between where the Fed is and the market is. The Fed, as stubborn as they've been on the hiking cycle, they're going to be, in our opinion, exceptionally stubborn. The barrier, and the hurdle to get to that first rate cut is going to be so high. Yeah. Inflation.
We would have to be in a deep recession. They would have to massively over tighten in order to have to cut. So I think what they're hoping is now they can slow the pace.
If you were betting right now, would you say 50, 25, 25 and hold?
I think the odds of December being 25 have gone up massively.
I think that's fair. I think that they're probably gonna, they're very wary of looking too dovish, right? And I think that that's going to be a theme. They've had this fighting retreat from 75 basis points, and trying to convince the markets that they're not doing a dovish pivot, and they've been at great pains to do that. And so, doing 50 basis points in December, if they feel like they can do it, and the market's pricing it in, and it's all baked into the cake, they're going to do that. But then, 25,
I think you would have to see very weak data in the next month, kind of a month and a half, by the time they meet in December to justify a 25. But that also could happen.
Look, I think that's right. That you'd have to, like, I don't know if there's enough time for that kind of pivot in that time frame, right? I think to John's point earlier, we're still a long way from the target rate. Have evidence that we would be approaching the target rate. So, like, it was a happy day yesterday. Today is a happy day. You could feel good about the path of the path and the pace of rate tightening, that it's not going to be worse, right? So if you thought that you were thinking about, well, if we get a bad number, today, you'd have to be thinking about 75 again. And so you kind of take that off the table a little bit, and it's not not that cuts are not on the horizon, but maybe hold is something that you could see on the horizon. And the market has that kind of certainty of where rates are going to settle for some period of time, I think you see the market take off.
I think so too. And that's what BlackRock is asking for. It's saying you've spent 10 years of overreacting both to the upside and downside. Why can't you just take a deep breath, raise a couple more 25, and then just keep it on hold for a while and don't do anything? And slowly reduce your balance sheet. And I think that's a perfect scenario for financial markets. The other thing about financial markets is the doomsayers are calling for, we're never going to go up for, 10 years. And what happened in 2021 is we went up, the S&P went up 30% for no reason. It was entirely liquidity driven. And now it's come back to where it was at the end of 2020. We are in a bear market technically, but really we just washed out the silliness of 2021. And now we can get back to trading on fundamentals, Are
you proclaiming the bear market over? Have we slayed the bear?
I think it is, yeah. I think this was just a bear, trade within a continuing bull market.
The other, massive news this week and in trades, not so much from a macro standpoint, but the big financial news this week is in crypto. The evaporation of the FTX fund, and who knows whether there's actual fraud or mishandling, but the drama around.
Oh, there was.
Yeah, I mean, alleged fraud. What do you guys think about this story? I mean, it's you follow crypto a little bit closer than I do.
Yeah, it really is. I think it's really shaken the entire crypto complex to its foundations. That is certainly not an overstatement from what we've seen. And the idea that you can have one of the leading figures in the industry and the institutions that he spearheaded, going essentially down the drain in a matter of days, is, I think, basically taking a heck of a lot of institutional money, a heck of a lot of smart money with it, is an enormous setback, I think, to the idea that crypto is ready for the mainstream, and that this is, an asset class that's beginning to get into the a significant maturation process. This just is such a a repudiation of those expectations. And is this the beginning of the end of crypto? That's not what we're saying, but this is certainly the start of a new chapter, a new era in crypto, where you have to start paying attention to fundamentals like collateral, risk management. That's what the maturation process is. Like, we had mainstreaming of crypto without factors that usually go along with mainstreaming, like really good governance and like competing on quality of collateral and business decisions and that sort of thing. So we got a little bit of the cart before the horse. And now I think in the crypto world, hopefully this is something that turns into a positive. You go back and there's more soul searching. Where does regulation come into this? Obviously, Gary Gensler is now empowered to do so, but at the same time, regulators are looking at what's happening in crypto and saying, you know what, this is proof positive that like nature is taking its course here. Like, the market is kind of doing some of the work for us. We don't have to scream from the rooftops that crypto is dangerous. FTX just proved it. So there may be, I think, we're skeptical that there's going to be a really hasty rush to regulate on the back of this. We think that, regulators are going to be thoughtful about this and take their time and try not to, go overboard or make hasty decisions on.
You think any legislation is needed to regulate in the space?
I don't know if regulation is. I don't know if legislation is possible.
I don't know if it's possible either.
Because I just don't think that there are that many, that many people in Congress that are all that. I think it's maybe this is a second half, maybe this is the next 2 years kind of project where you begin to really start doing the homework and getting some clarity on this stuff. But the current legislation that's out there right now, I don't think is really, from where we sit, isn't really fit for purpose in the current mindset.
And so much of it has to be, on a case by case basis. So when I send you a wire from JP Morgan to your, say, Citi account, the actual transaction is instantaneous. When JP Morgan sends it, Citi has that money immediately. We have the technology in the modern banking system that the crypto industry does. But the reason it takes a day and costs me a bunch of money is because of regulation, to make sure that I'm not money laundering, to make sure it's me, to make sure that I have enough money in my account. That's why the modern banking system is slow and clunky. And that's what the crypto industry is saying. We can't be regulated because then it takes away all of our advantages. So I think that's over time what you're going to see. I think that the technology behind a lot of these crypto technologies, it's very interesting, but I don't think that it's worth what everyone is valuing at. Like I don't value my wire transfer. That's not worth $10 billion. So why is an NFT worth $10 billion?
Yeah, I think. Look, I mean, it is you can have any kind of asset, right? I mean, it's here's just where I have a question, and I should note that Penta has clients in this space, in blockchain and crypto and market making in this space. And I don't work on it, but the firm does. But my view is that you can anything is an asset, right? I mean, Monets are assets, right? If you want to trade Monets, once you financialize the asset, then you do enter space where financial regulators have an interest. And then if you are marketing to investors of all kinds, whether they're qualified investors or the public investors, in whatever way, government has something to say about that, and certainly on if you're transferring money, obviously know your customer, beneficial ownership of things kind of need to be known, and those are basic things. The financialization of the assets are like someone needs to know the provenance of these things, and we can always just say due diligence, it's like, and market discipline. So we're getting market discipline today. Sam Bankman-Fried has just filed for voluntary bankruptcy protection, or has it started the process? Those are market discipline things, but the investing community suffers, real harm because no one is enforcing some basic fundamental discipline on them. And the thing that's most breathtaking about this particular episode is that he was seen as like the safe guy, the good guy, the responsible person in the space. Yeah. And there was a view that all the others, a lot of the others were less so than him. That was part of his celebrity, was that, well, this is a good guy who's not trying to mislead anybody, and he's being transparent about what he's done. And it appears that, he's built, structures look something like Ponzi schemes and good old fashioned commingling of funds, maybe without any oversight. And like, that's a story that's told 1,000 times over, right? It's like, these are not novel things in the financial world. These things have a long history, and just looks like good old fashioned, old bad practices with new technology.
Yeah, and the CEO of Binance, who backed out of bailing them out today, told a group of investors that he thinks this is really the 08 moment for crypto, where this is just the beginning, and because everything's so interconnected, you're going to see a lot more bankruptcies, a lot of people go out of business, and then you're going to see regulation of the industry, and there are companies that will make it through it, just as, we still make mortgages, but we don't package them together and slice them into completely worthless mortgage-backed securities.
Yeah, and then there's the case to be made that this is just going forward, we're in such a fundamentally different financial market environment, whereas it's just hard to sort out the kind of assets and price action and whatever it is and things that were really popular in the free money era, that monetary magicianship era. 4% risk-free rate is a bracing reality, and it creates a completely different environment. I saw someone on Twitter, I really like this. This is obviously kind of talking our own book and our own thesis, which we've held for quite some time here, but he put it so well. It's the tangible 20s, right? Like if you have a cost of capital that's real, your company, you can't necessarily build castles out of air in the same sort of way that you might do. And, they talk a lot about zombie companies and that sort of thing. There's a painful transition. I think that we're kind of at the foothills of that potentially. And, but, it has the potential to bequeath us a more normal and productive kind of economy. And that maybe is the, again, wish casting into the future and trying to find silver linings. But, that sort of, the real fundamental building blocks of the economy, real interest rates at a respectable level that are bracing and disciplining, and you go out and make real value for real people in your economic and business transactions. Hey, that let's hope we get there.
Yeah. Well, that's the thing, right? I mean, at the end of the day, right now, because there haven't been great established use cases for crypto, people don't actually need them. They just may need them as collateral because they've levered, right? So there's like sort of it's again like there's not the use case. There's just the using them for financial machinery at the moment. And so it's not like so you think about the 2008 moment, like people forget, like even most subprime loans paid. Right? You could, at the end of the day, you could hold a lot of subprime mortgages that hold them to maturity, and the vast majority of them, even subprime no doc loans, actually performed in the
right. The equity component of that MBS got wiped out, but the first holders got paid in full. We just sliced that loan up too many times, but the actual loan ended up being fine. So this is kind of how I look at the crypto world. So right now in the music industry, if you're starting a band and you're getting on YouTube and you're trying to create a name for yourself. So what they're doing is they're using the NFT technology to I can buy basically an NFT, which really is just a technology that allows me to know that I own this. So now I am incentivized to promote your music, but more importantly, this NFT gives me a flow. I own now a percent of your future earnings. So if you become U2, that NFT is going to be worth a lot of money. So the NFT isn't worth anything. The technology is not worth anything. What is worth something is my ownership of this band.
Yeah.
Before, you were buying NFTs of pictures of monkeys that were worth $20 million. That's completely worthless. The technology has value, but only in connection to something that actually has a worth.
And with that, I'm conscious of our time, as this is your final Macrocast. Tony, we want to thank you again. You were the godfather of this podcast, no question. This is your baby, and we have enjoyed working with you week in and week out over all these years, parsing some of the most challenging stuff. So I want to leave you with a valediction, if you don't mind. I don't want to put you on the spot, but with the time,
just I'd say, look, I know a lot of our listeners love the show. I hear from them all the time. I could tell you, I personally am going to miss it a lot. It's if you're a listener right now, you don't know, I'm going to Goldman Sachs I start on Monday as the global head of corporate communications there, which I'm very excited about. It's a great opportunity. but I have to be a lot more careful about how I talk about things, macro and financial now going forward. And so I may try to find some opportunities to join you guys on the show and talk about things, but I won't have the freedom that I used to have, because I'll be representing one institution, but one great institution that I'm really excited about. It's been a joy and a thrill to do it with you guys. So honestly, I look forward to Friday morning every week. I listen to the show on the times when I'm traveling or have some commitment. I miss it. I always check in and listen to the show, and it's a great contribution to a lot of people who for some of our friends, some of the people we know around town and around the country, who get a chance to listen to us for 30 minutes, and they're not following macro all the time. So some of them are deeply following macro and markets, and they like it. But people who this is their bite at the apple for the week, is to get a good sense of what's going on, and it's been great to be able to do that.
Well, it really has been a pleasure, and we can't thank you enough for putting this all together and giving us this platform. So and sharing it with us, and really always a firm hand on the tiller. You guided us through some fantastic twists and turns in the macro world. So thank you again, Tony. And we can't wait to host you as you when you come back in your new position.
I'm looking forward to it. Have a great weekend. Great show as always. And everyone, go honor a veteran this weekend.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.